Hide your kids, hide your wife. The stock market is in turmoil. Well, I might be exaggerating just a little bit, but stocks did get dinged today. So the Dow closed the day down about 1.1%. The S&P 500 closed the day down about 0.8%. And then NASDAQ also closed the day down 0.8%. So this is not exactly a bloodbath. There's no reason to panic just based off those numbers. But I should mention that a lot of the stocks that I like to trade, which are growth stocks, got hit even harder. I actually had to take quite a few growth stocks off my watch list. So the first time I had to really do that in a while. And there's also several other stocks that I'm watching, growth stocks, that look especially vulnerable as we go to close out the week here. So in this video today, I'm going to cover a few reasons why I think stocks could be under pressure right now and could remain under pressure for the near term. I'm not a perma bear by any stretch of the imagination, but this is just some information that I've been seeing while reviewing charts that I felt that I needed to share with people. So before we get into the good stuff, though, I want to welcome you to the channel. In case you're new, my name is Justin Spittler. This is my JSpit Trades channel. You can also find me on Twitter at JSpit Trades. Over there, I share charts and ideas, basically the same thing I do over here, but just in Twitter format. So check me out over there if you haven't already. So with that being said, let's just dive right into it. So the first thing we're going to look at is TLT. This is the 20-year Treasury bond ETF. When a lot of people reference the performance of bonds for a given day, they're often talking about TLT. It's a lot of people's favorite benchmark for performance of bonds. And when we look at TLT today, you can see it closed the day down about 1.4%, which is actually a pretty big move for TLT. So bonds are not supposed to be as volatile as stocks. And today, bonds closed down almost twice as much as what the S&P 500 did. So that alone in itself is pretty notable. On the week, we're now down about 3.2% on TLT. So not a great week for bonds. And when I look at TLT here, the thing that has me a little bit concerned about the near term is you can see, I'm going to throw this 200-day on. So you can see that after bottoming in October, we've been trading sideways in this range. And I actually thought after trading this range, we might be able to, build a base and begin an uptrend, or at least start to climb out of this this area that we're in right now. But you can see this blue line here, the 200-day moving average. We've just been unable to reclaim and stay above that key level, and it's just starting to flatten out now. So maybe it's a little bit premature to think that bonds are about to bottom. But if that is the case, and bonds, head lower or break down from here, that could be a big problem for the stock market. Because if you know anything about bonds, so when bond prices fall, that means interest rates rise. They're inversely correlated. So when we look at TLT here, it's pulled into this key support level, which it's tested a few times, and it's in a downtrend. So, trends that are in motion tend to stay in motion. So I could definitely see this breaking down, and we could possibly come back and retest those October lows, which we're not too far off of right now. So that would be a 7% drop in TLT, and that would coincide with a move in interest rates on the long end of the curve, which would be a potential big problem for the stocks, for the stock market, and possibly the economy. So that's definitely something to monitor. Even if you lean bullish, you want to be aware of these potential scenarios. You just need to be objective. So that's what I'm seeing from TLT. When I look at IEF, so this is the 7 to 10-year Treasury bond ETF. You can see it's also basically a piece of crap. You can see here the 200-day moving average. It reclaimed it and stayed above it for a few weeks, but we just couldn't hold it. And this 200-day moving average hasn't really even flattened out yet. It's still in a primary downtrend. So that's a little bit concerning there. And you can see this week, we've gotten hit pretty hard. So today we closed down about 0.8%. So pretty much in line with what the S&P 500 did, but we're down about 2% on the week, which is not great for bonds. It's a pretty decent drawdown on bonds for the week. Similar to what we saw in TLT, we're pulling back into a key support level here. We're not quite at the October lows yet, but we're pulling back to these March lows that we tested previously. So this is a level that I definitely would like to see buyers step in at. That would, I think that could potentially alleviate some of the pressure we're seeing in stocks right now. So that's definitely something to watch. But when you look at IEF and you look at TLT, they're looking pretty weak. So that's a bit of a concern. The other concern I have is more of a long-term concern, but it's getting on my, it's popped on my radar more recently just because of the sell-off and how bonds have been under pressure the past few weeks. So when we look at this chart, which is the U.S. Treasury 10-year yield, so we can see that since between the early 80s and just before COVID, so right around COVID, 2020, bonds were in a 40-year, 4-decade downtrend, and that coincided with a period of prosperity for America. The stock market did really, really well during that period. Interest rates are the cost of money, so when they're falling, it gets cheaper to borrow money. So it just it's good for asset prices. It's good for the economy. But the thing that's changed recently is that, after bottoming in 2020, we had this huge run up, and this big move that we saw last year was one of the biggest reasons we saw stocks under pressure last year. So that was a bit of a concern when rates were rising really rapidly. And that was creating all sorts of problems. And now when we look at this chart, so we've broken this 40-year downtrend, and we're holding above that downtrend break. So this is looking like a confirmed breakout. We've also flipped this support that dates back to 2018, and we're holding that level. So that's the monthly. That's the really zoomed out level. But when we zoom in closer. So this is the weekly for the U.S. 10-year Treasury yield. We can see that we're holding this level. So you can see we test. This level was tested here, and we tested it more recently, and we're holding it. We're starting to build out a little bit of base here. So if this was a stock, or a crypto or whatever, a different sort of asset that I might be inclined to trade, like this is looking pretty bullish. The thing that remains to be seen when we look at the 10-year yield is, are we just going to break out of this now, or is there potential that we come up? We try to break out, really like reclaim this 4.2 level, and then we pull back down. We just spend more time trading sideways. So that's really the big question for me, because I think if we do, break out of this little base that we've been building, rates could go materially higher, and that's going to create problems for both the economy and stock market. So it's definitely a situation that I don't think you should take lightly as an investor or trader. I'm not saying that, this is not a reason to panic. We don't know how this will all unfold. It could take much longer than any of us anticipate, but it's definitely something to monitor closely and just be aware of. So that's it for the bonds and rates discussion. But now I want to pull up another chart that concerns me just a little bit in the near term. So this would be the U.S. dollar index. So last year, the dollar was really ripping face, which coincided with the big move in rates. And that was, one of the major reasons that stocks just had a lot of trouble last year. But this year, and really beginning in late last year, October, September of last year, you could see that's when this was starting to top out, which just so happened to be when stocks bottomed out. So, if you're confused about the relationship between how the S&P 500 performs in bonds, you could just go back to last October or late September, and you can see that when rates were topping out, that's when stocks were beginning their bottoming process. So it's pretty notable. So since then, though, we pulled back, and we've had some rallies since putting in that initial bottom in February. We had this rally up here, got rejected, pulled back into support. A lot of people thought the second attempt off support would be what took the wind out of the stock market sales, but that didn't happen. So we had this rally up. Stocks and the dollar actually were basically rallying at the same time. So it wasn't the headwind concern that a lot of people were worried about. What has me a little bit concerned now is, so we pulled back, we bounced off this level. So I drew another trend line here, and now you can see this chart is starting to go up and test that downtrend level again. We're not quite there yet, but if we do test that level and break out of it, that could be a problem. That could mean that the dollar is going to rise, which could create problems for the stock market and other risk assets. So that's definitely something to be mindful of. The other thing that kind of concerns me about this chart is when you look at the dollar, just how it's traded recently. So I'm going to take this 200-day out of there. You can see that's just starting to get tighter. So as I often point out during these videos and on Twitter, when you see the price action of an asset start to get tighter, it often precedes a big move. It's sort of the asset's way of storing up energy for its next move. And when we look at the dollar, it's still, since having that really blow off top late last year, it's still in a primary downtrend, at least in the intermediate term. So you can see this 200-day moving average, it's below it and it's declining. It's starting to roll over. So there's a possibility we break out of this or have a date with the 200-day moving average. Maybe we get rejected there. But if we do break out of this, hold this level, and then reclaim the 200-day moving average, that could be an issue for assets, for risk assets, stocks in particular. So yeah, I mean, I just wanted to put this video together and highlight a few things that I'm watching right now, mainly rates and what I'm seeing in the dollar, and just performance of bonds lately, because it can have a really big material impact on stocks and other risk assets. So even at this stage, I'm still pretty bullish. I still like how a lot of stocks are setting up, but this is definitely an area of the market that I'm gonna pay extra close attention to going forward. So that's it for today. Hope you found this video informative, and until next time.